Hi, everyone. I'm Mike Pacito with IM Global Partner. Thanks for joining our monthly update on the IM Global Partner DBI Managed Futures ETF strategy, ticker DBMF. As always, I'm joined by co founder of DBI and co portfolio manager of DBMF, Andrew Beer. November was an interesting month, to say the least, and while we like to keep these video updates short and to the point, there's a good amount to cover, so I'm going to spare the audience any further prefacing here and get straight to you, Andrew, for your comments on performance, positioning, and markets in general. Please begin.
Thanks, Mike. Boy, this has felt like the year of the whipsaw. As our clients know, after a very strong 2022, we had a rough first quarter, then rebounded between 9 and 10% through October, then gave back a bit more than half of those gains in November. We were down around 5%, slightly worse in both the SocGen CTA index, here and after the hedge fund index, and the Morningstar US trend systematic category, here and after the Morningstar category. And are trailing the overall spaces here by 300 to 400 basis points. To be clear, from a replication perspective, we are not concerned about this. Variations like this are to be expected. Our correlations remain high, and we know from multiple models and sources that we are accurately capturing the core positions across the industry. As a reminder, replication outperformed both hedge funds and mutual funds in 2016, 2017, 2018, 2019, then matched in 2020, only to outperform again in 2021 and 2022. Still, it is, of course, more frustrating that underperformance this year is happening when the overall space is having a tough year. For professional investors, we're hosting a Zoominar in a few weeks where we'll dive into more of the nitty-gritty on this, so please keep an eye out for an email from Mike or reach out to iMGP directly. On the macro front, softer inflation and dovish Fed speak caused a sharp reversal in rates. Overnight, we went from higher for longer, or maybe higher forever, to taper tomorrow. The key economic question is whether Powell pulls off this immaculate landing, i.e. inflation drops nicely with no recession, or whether the economy is hitting a 500 basis point hike windshield. Regardless, expectations that the hiking cycle is over sparked a massive risk-on rally, with the S&P 500 soaring 9%, recovering all of its losses from the prior 3 months, and the Bloomberg Ag up 4.5% and clawing back into positive territory for the year. So while we often talk about DBMF as a beacon of green in a sea of red, and that was very true in September and October and of course 2022, last month we were a red blotch in a sea of green. But a sea of green or a sea of red should not be comforting to wealth managers. It means that diversification isn't working the way it used to. The correlation between the S&P 500 and Bloomberg Ag this year is an alarming 85%. If you have a minute, take a look at our website, dbi.co, and a set of slides we wrote called The Great 60-40 Head Fake. The punchline is 60-40 worked beautifully for a decade, but allocators need a different playbook this decade, as we clearly saw last year. On the macro front, I'd like to take you through 2 slides that I think provide some helpful context on this macro world. With that, next slide, please. So this is an amazing chart prepared by Bianco Research. In short, it shows the market has been wildly and consistently wrong about the direction of interest rates since 2010. That black line is actual short-term rates, and each of those filaments is where the market thought those short-term rates would go over the coming year or two. We call this slide "Don't Believe the Hype" because it shows that the market, quote unquote, has no clue. During the 2010s, it was in disbelief that rates could remain that low. So each year it expected rates to rise 100 or even 200 basis points in short order, yet it never happened. Then during COVID, the market was utterly certain that rates would not rise for years. One line goes all the way out to 2026. Then when rates started to rise, the market underestimated it each step of the way. So the point is to be very, very skeptical when you hear people tell you where rates will be in a year. And if you feel like torturing them, ask them to provide their time-stamped predictions over the past decade. There's a chance that the next year will be smooth sailing. The Fed tapers, rates drop, both stocks and bonds rise. We're all happy. But it's not likely, and you might want to plan for stormier seas. Next slide, please. For anyone with a memory that extends all the way back to, say, October, you might remember people saying that the rise in 10-year yields was, quote, tightening financial conditions, end quote, and that the bond market was, quote, doing the job, end quote, for the Fed. The argument was that this meant the Fed would not have to keep raising rates. So what's happened since then? The 10-year Treasury yield plummeted 70 basis points and risk assets soared. This chart from Goldman Sachs shows financial conditions easing significantly over the past several weeks. By one estimate, this was the equivalent of 90 basis points of cuts. So two conclusions. First, even if you think the taper is a done deal, it could well be priced in. Secondly, unless the Fed secretly thinks the economy is hitting the windshield, they cannot be happy about this and will likely have to go back to jawboning the market with threats that they're not yet done. This circular dynamic is why rate volatility has been so frustratingly high. And speaking of this, let's take a minute to look at why this rate volatility has been both a good thing and a bad thing for CTAs this year. Next slide, please. This chart, called Anatomy of a CTA Whipsaw, is a very simple representation of what happened in November. The big driver of CTA returns, as you know, is trend following. This chart shows the yield on the 10-year Treasury this year. Basically, yields were oscillating violently during the fourth quarter, taper to higher for longer to fears of a global banking crisis. But since then, they marched steadily upward. Trend followers often use multiple windows, which provide some diversification. When you have a long and persistent trends, the models line up behind it. So this very simple graphic simply shows how by the end of October, both shorter term and longer term models were betting that yields would keep rising, e.g. short treasuries. But now imagine you did the same thing back in May, whereas the longer term models likely would have still been short and hence made money as we did on the subsequent rise in rates. Shorter models had pivoted out and hence were wrong-footed. More broadly, since the moves in many assets are interconnected, big moves and big reversals like this can play out across multiple positions simultaneously. November was a case study. Now, for my perch, as frustrating as these reversals can be, I try to keep perspective. The flip side is that these big waves, like those in 2022 in commodities, rates, and currencies, are also the most fertile area for alpha generation over time. So like with periodic drawdowns in equities, we should try to condition ourselves to accept these kinds of reversals as the natural variations inherent in this and any investment strategy. On to the next slide. To continue my drumbeat, here's our usual slide on DBMF for performance since inception versus stocks and bonds. We've generated 900 basis points of alpha per annum relative to the S&P 500. I'm just not aware of a hedge fund ETF that's ever done anything like that. Just tracking the lines, you can see that we've been very negatively correlated to equities for much of the past 2 years, which helped a great deal during 2022, but has cost us over the past year. Meanwhile, bonds have been dead money for this 4.5-year period. So when I think about DBMF, I always try to frame it as a tool, a strategic allocation in a larger multi-asset portfolio. Which brings us to the next slide. What if an allocator had decided to go from a 60-40 portfolio to a 50-30-20 portfolio of S&P 500, Bloomberg Ag, and the SocGen CTA Hedge Fund Index when we launched back in 2019? So for compliance reasons, we must show the hedge fund index returns, not DBMF returns, but the general conclusion is similar. Over the past 4+ years, returns would have been approximately the same, but month-to-month volatility would have dropped by over a fifth, and the max drawdown was approximately 40% shallower. That would have been a huge improvement. But remember, our allocator is not trying to be a hero. Maintaining a high correlation to the 60-40 benchmark is important. And here the portfolio would have achieved these results with a 98% correlation to the benchmark, which shows why non-correlated assets with high alpha generation are so valuable in diversified portfolios. And to round out this picture, let's hop to the next slide. Here we show the rolling 24-month standard deviation of a 60-40 portfolio. It's something we cover in those slides on our website that I mentioned. Basically, in the past 2 years, 60-40 portfolios have been hit with a double whammy of higher vols in stocks and bonds, plus that 85% correlation means they're not hedging each other at all. So a typical client might have been thrilled in November, but comparatively miserable in each of the preceding 3 or 4 months. To follow the last slide, the potential 20% allocation to the SocGen CTA index would have delivered a more stable volatility over the past 2+ decades, especially during periods when vol spikes like here. In the past few years, it would have capped vol around 10%, not as low as it was 5 or 6 years ago, of course, but much lower than it has been. In recent months, the impact would have been very pronounced, reducing volatility by around a third. So 60-40 was great during the 2010s, but we think this brave new world requires a new allocator toolkit that incorporates more diversifiers with low or even negative correlations to both stocks and bonds. Next slide, please. And here's our standard chart on volatility-adjusted positioning. Our positioning hasn't changed that much over the past month. I think a lot of people expect CTAs to start pivoting out of positions the day they start to reverse. That's really not how it works. Thinking back to that chart on the 10-year Treasury, even with a sharp drop in rates recently, the trend is still up over longer windows. Big and long moves mean CTAs will hold positions longer during a reversal. And that's absolutely fine because longer term trends, which DBMF tends to pick up on, are the most important driver of alpha generation in this space. Yes, managers that use shorter term models will have pivoted quickly, and those with vol constraints will reduce risk faster. This did help them in the latter half of March, but remember that it also cost them when rates resumed the trend upward. As we've studied the issue, our general conclusion is that while these things sound great on paper, they just often don't work that well in reality. So remember, by the time a stop loss or vol control or shorter models are de-risking, most of the whipsaw damage has already been done. We plan to discuss this in more depth on that upcoming Zubinar. So there's no perfect answer, and it can be perfectly rational to combine DBMF with single manager funds with some of these features. Today, I do like our positioning because it feels like the market got ahead of itself last month. And again, unless indeed we are hitting the windshield, in which case we have a host of other problems, we could well see a reversal, so to speak, of some of the November reversal. And we're well positioned for that. With that, I'll hand the baton back to Mike.
Thank you, Andrew. So for anyone who may be new here to DBMF, this is just a quick executive summary as to why we believe it's a game changer within the managed futures space. Index plus replication approach, low relative fees alongside efficient underlying construction that reduces much of the expense drag we all know is high within this category, mitigation of single manager risk that causes uncertainty of returns, and lastly, the ETF's efficiency, making liquidity and access issues very simple for implementation. So let's wrap with our standard comparative slide where we showcase the since inception performance of DBMF versus the index and versus the Morningstar universe. Long-term outperformance, which is what we focus on as strategic allocators and investors, again, against the index has narrowed somewhat since our last update, but DBMF is still beating the SocGen CTA index by over 200 basis points annualized since inception. And outperformance against the Morningstar average is 389 basis points annualized since inception. So we hope that you find these results to be convincing and compelling. So I'll just close here by saying thanks to all of our clients and all of our prospective clients for your confidence and for your interest in DBMF. If you have more questions about the strategy, would like further information, or a call with us, please don't hesitate to reach out. Just send us an email, team@imgpfunds.com. Until next time, from DBI and from iMGP, thanks for spending time with us.